Hi, good morning, everybody. Thank you all for joining in. We'll just wait for a couple of more minutes for more people to join, and we'll start in about 5, 7 minutes. Yeah, done.
Hi everyone, thanks for joining us today. Um, so the topic for today is going to be on is portfolio management services better than mutual fund investments. Harshal and I will be conducting this webinar. So investing can often feel overwhelming because of a lot of choices that are available to us. So two of the biggest options that stand out for investors today are mutual funds and portfolio management services. So both are designed to grow your wealth, and both are designed a little differently to suit different kinds of investors. So in this webinar, we'll be taking a closer look at how PMS and mutual funds work. We'll be discussing the pros and cons of both PMS and mutual funds. And we'll also be looking at what makes them suitable for different goals and different investors, and how you might be able to choose between one of them. We'll start with the basics of what are the options available for investors. So here we've listed four options that are available for equity investors in this market. So the first one is mutual funds. And within mutual funds, we've not categorized this across equity, debt, or multi-asset or commodity funds. We've just taken a more broader categorization of mutual funds and the PMS. Within mutual funds, the one category is open-ended mutual funds, and the second is closed-ended mutual funds. Open-ended funds are those which you can enter at any point in time and exit at any point in time. They don't have any limit of how long you'll have to hold it, or there's no maturity as such. Most of the funds that are available in the industry today are open-ended mutual funds. The second category is closed-ended funds, where these are usually debt mutual funds that come in the closed-ended category, where there is a start date within which you can subscribe to a mutual fund. And once you buy it, there is also an end date where it matures, and after that you can't hold on to it any longer. So there's an entry date and there's an exit date. That's what a closed ended mutual fund means. And within the PMS, there are again two kinds of PMS options. One is discretionary PMS and the other is non-discretionary PMS. Discretionary PMS is where a fund manager has full control over the portfolio. So whatever decisions on what he decides to buy, what he decides to sell, or if he wants to stay invested in a particular company, what kind of companies he wants to invest in, all of these decisions lie with the fund manager. So fund manager and its analysts are responsible for all the decisions on behalf of the investor in a discretionary portfolio. And in a non-discretionary portfolio, the investor has the final say on the investment decision. So here the fund manager and his analysts would be working on the research part of it, and they will put forth their advice to the investor on this is what we'd like to do, this is how much we'd like to buy in the portfolio. And the decision of if the investor would like to go ahead with the investment or not lies with the investor. So this is the second kind. This is a non-discretionary PMS. And the third option that is available to investors is alternative investment funds. These are typically for, so again, if you look at the entry sizes of entry tickets of each of these investments, mutual fund do not have any minimum investment size. PMS investments have a 50 lakh minimum investment size. Alternative investments have a 1 crore minimum investment size. So alternative investments are again further categorized as category 1, 2, and 3, where each category has a different style of investment, has different guidelines that are set for each of them. But most of the AIFs that are available in the market today are equity AIFs. So one flexibility that these AIFs have is that they can also take investments in areas like derivatives. They can take positions in derivatives. So this is one flexibility that AIFs have. There is within AIFs, I mentioned that there are a few categories. There are a few category AIFs where they can buy private equity investments or they can take part in as venture capitalists in private companies. So this is a flexibility that an AIF offers, and this is typically used by people who have a lot of money for HNIs and ultra HNIs. And the fourth one is a very recent category that SEBI has introduced. This is yet to come into effect. So far, SEBI has only given us information about what the guidelines for the investment is going to be. It's called Specialized Investment Funds, SIF. So this was introduced between a mutual fund and a PMS. So I mentioned mutual funds do not have any minimum investment, and PMS has a minimum 50 lakh investment size. SIF comes in between, it has a minimum of 10 lakh investment size. Here again, SEBI has put forth certain guidelines on who can be a fund manager here. So far, they have told that somebody that has historically managed 10,000 crores and above on average and has more than 10 years of experience in fund management is someone that can launch an SIF and can manage it. This is something that we are yet to start seeing offered by any of the fund houses, but this is going to be an interesting investment option. But this is known to be, or this is proposed to be a little more riskier. So a mutual fund investor who wants to add a layer of risk to his portfolio is somebody that can consider an SIF, because this is also an investment option which can take derivatives into its portfolio. The fund manager has the discretion to buy stocks, he can buy debt, he can buy commodities like gold or silver, and he can also trade in derivatives. So these are all the options that a fund manager will have in the SIF space. So we'll move on with a poll. So let's say you're comparing between a PMS and a mutual fund. So what would compel you to choose a PMS over a mutual fund? Would it be higher returns? Would it be a better strategy because the existing mutual fund ecosystem is not offering you something that a PMS is offering you? Or is it C, that it's just direct stocks? I have enough mutual funds. Let me take some stock exposures. Is that what is driving you to a PMS? Or is it the fact that a PMS can customize your portfolio a little further than a mutual fund? So we'll just wait for a minute. We'll be happy to hear your responses in the chat box. So why would you choose a PMS over a mutual fund? Okay, we're receiving a few responses. Okay, we have responses across all the options. Higher returns, better strategy, direct stocks, customization. Okay, great. So when we have responses across all of these, so it's clear that we have a very mixed set of crowd in the audience today. That's good to know. So we'll just immediately move on to just busting a few myths or two myths in particular. So one myth that we keep hearing from investors who want to start a PMS is that they want to come on to a PMS, or they feel taking on direct stocks will directly equate to higher returns. So they keep saying that if I invest in direct stocks, I'm going to get higher returns. So why take the exposure of a mutual fund? So many investors assume that just going towards a PMS or owning stocks just guarantees superior performance. So we'll have to look at this if that's really true. But so the thing is, buying direct stocks may not always translate to better returns. Whether you invest in direct stocks or through a PMS or on your own, you have to remember that these are just investments that drive investments. Sorry, that drive returns. It's the process and the expertise behind the investment that is going to drive your performance. For instance, people sometimes just forget that mutual funds also invest in stocks. However, the difference lies in the fund manager and their process. A very good fund manager would employ some robust strategy to pick and manage stocks. So this would ensure that a portfolio is aligned to your financial goals and the current market environment. So it does not really matter if you are going for a mutual fund or a PMS in this case. What you'll have to look for is if this is a good fund manager that you're going to be working with, if they are following a good process, a reliable one, which can deliver some superior returns, some sustainable returns. So here your takeaway is going to be that when you choose an investment avenue, you'll have to prioritize that a fund manager's track record and their process is what you have to follow, and not just the returns or the type of investment that you go for. So one primary a very common example that we can take for direct stocks may not equate to good returns is a case of Hindustan Unilever, where the last 5 years they've generated lesser than inflation, lesser than fixed deposits in spite of their company growing at double digit. Their profits have been compounding at better than 10%, but their stocks have only done lesser than 5% over the last 5 years. So this is just one of the examples. I'm sure there are other examples which also show that some stocks have done extremely well. But this is just to show that direct stock picking may not only equate to better performance. Moving on to the second one is that longer term investments are so there's this narrative that if you stay long term in any sort of an investment, you're going to make good returns. So if you're coming into the markets, just stay long term. So this is, yes, it is true that you have to stay for the longer term, but it is just one part of the story. So compounding does work magic over a long term, but the key to compounding is not just blind inertia. So it has to have some strategic realignment in the portfolio. Sometimes a stock or a fund that you've invested in may no longer fit the current market context. So this is where the idea of an active portfolio management comes into play. So if you think of certain companies or sectors which were thriving 5 years ago, may have lost their competitive edge today. So holding on to such investments in today's market without reassessing their potential might cost you your valuable growth opportunities. So long term does not necessarily mean inaction in the portfolio. It just means staying committed to your goals while making necessary adjustments as and when they come to capitalize on some market shifts. So the key takeaway here is going to be that long-term investing requires patience. Yes, that's true, but it also requires some vigilance. So we have to be proactive in ensuring that your portfolio remains aligned to your long-term objectives. So we'll move on to discussing some strengths of a PMS and comparing it to a mutual fund. So in each of these bullet points, the first point is going to be on PMS and second point on mutual funds. I'll first run through the PMS points and then I'll move on to the mutual funds points. So the first point on PMS. So when an investor comes into a PMS, or when he opts for a PMS, one of the primary reasons that they look for a PMS is customization. So yes, you may think that mutual funds can also offer you customization. Yes, it can. If I'm going to build a portfolio of 3, 4 funds, I'm already getting a well diversified portfolio with different strategies. I may have a large cap, a flexi cap, a small cap. So I am diversifying it. But in a PMS, we're able to go a little granular in terms of customization. How? So there is this restriction for mutual funds that when an investor gives a mutual fund money, they have to be at least 90 or 95% fully invested. They can't hold cash for a very long time. So this does not apply for a PMS. PMS has its own discretion on when they can deploy capital, how they deploy capital. So for instance, if you take iThought's PMS schemes, we take our own time to deploy capital based on how the market situation is. So we work very closely we look very religiously towards valuations. We may have identified a good business, but if valuations are not in our favor or is not in the PMS's favor, then we may not deploy this fund until we see it come into our buying price. So this level of customization in terms of buying and also in terms of choosing companies. For example, you may opt for a PMS which only does large cap investing, but maybe their process is only to buy into large caps which have no debt in their books. Or you may opt for a PMS which does all kinds of investments except banking investments, because mutual funds mostly cover banks. So this sort of customization is something that you would get from a PMS, which a mutual fund cannot offer. The second point on PMS is going to be risk management. So this again is an extension of the customization point. So when I say risk management, here we're going to look at two things. In terms of risk management, one, the price that an investor pays to or a fund manager pays to buy a stock, and two, the kind of company that he wants to buy in the portfolio. So in a market like this, where we're seeing a lot of uncertainty, most of the market today is in overvalued parts of the market or overvalued segments of the market. So in such a market, a PMS fund manager can simply decide that there are only 10 stocks that is available at a price that I'd like to buy. So I'm just going to buy these 10 stocks and I'm going to wait on cash. So what happens here is, if there is a case where the market starts correcting, or if there is more volatility in the market, the fund manager naturally starts getting more opportunities to deploy. This is one. Two, since this fund manager does not have the urgency or he's not forced to deploy this fund. So he can wait in cash and he can buy companies only when he finds these companies to be favorable in valuations. Again, when he buys companies when they are favorable in valuations, what this means is when the market starts going down, he may be in a position where if the market is going down by 10%, maybe his portfolio would go down by only 5% or 4%, because he's already bought something that is cheaply valued. Yes, he will also take a hit, but he will take a lesser hit than the entire market. So this sort of risk management that a PMS can bring into your portfolio is much superior than what a mutual fund can bring into your portfolio. And the third point is on consistency of investment style. So when we review mutual funds or when we look at a set of mutual funds that are there in our portfolios. So we recently did a study of looking at 10 years of worth of mutual funds that we picked in our portfolios to see how fund management style has changed or how fund managers have changed. We noticed in a lot of these cases, the fund manager keeps moving from fund house to fund house, or they keep moving from fund to fund. So this itself, let's say a mutual fund, let's say an investor who is in mutual funds picks a fund and he wants to stay invested for 10 years or 15 years. Over the course of this period, often there is at least a 2 or 3 time fund manager change in the portfolio. So what happens here is there is a complete shift in the investment strategy. So the first fund manager might have been following a certain style of investment. Maybe 3 years, he's built a certain portfolio. Then the second fund manager comes in and he starts building a portfolio of his own strategy. So he's basically changing the entire strategy for the second time. Then again, another fund manager comes in and he starts doing things that are suitable for his style. So this is something that you may not see in a PMS, because PMS runs as a fund house. And most cases, this is run by somebody who's a CIO, and he is the person who started this investment fund itself. So the investment style remains consistent over 10 years or 15 years or 20 years. So this is going to be a process or a fund management style that has been just pushed into the system itself. So if you're engaging with a certain PMS house is going to be the same sort of investment style and the process that they're going to follow over prolonged periods. And if you come to the advantages of a mutual fund, so the first one is on easy entry. So a big disadvantage for for PMSs here is that they have a minimum investment requirement of 50 lakhs. For mutual funds, that does not apply. You can start with any sort of investment. It can be as small as 500 rupees or a 1,000 rupee SIP. So this offers extreme access to people who want to, for people who even started earning now, who have very little capital. Mutual funds is a product which gives them very easy access to invest. The second one is liquidity. Again, mutual funds have a very easy way of liquidating their investments. They have no lock-in period. If somebody is investing for a certain type of goal, let's say they want to pull out money in 1 year and they invest in debt funds, this money is going to be available to them 1 year later in just 1 day. They can withdraw in 1 day. Same for equity funds, trade plus 2 days is how long it takes for them to liquidate their portfolio. And the third point is on taxation. This is an argument that often comes up when we discuss PMS and mutual funds, where within a PMS, every time there is a stock trade that takes place, tax applies on the investor. Whereas in a mutual fund, how many ever changes that the fund manager makes within the portfolio, he may change the portfolio, he may change even 10 stocks or 20 stocks in the portfolio, and none of this is going to impact the investor as long as he stays invested in the fund. The investor in a mutual fund gets taxed only when he exits the fund. Let's say he's staying invested for 10 years and the mutual fund manager has made hundreds of changes in the portfolio. This is not going to impact the investor at all. He's only going to pay a tax when he's going to walk out of the fund 10 years later. So moving on, I'll be passing the mic to Harshal, who will be discussing about how an investor over different life stages of their life can discuss or can choose between different options of mutual funds or PMS.
Thanks, Manu. So we usually get this question on, when do I do a mutual fund? When do I do a PMS? And we often speak to them more from a case to case specific, but from a broader sense, from all the feedback that we got, we wanted to split it across it being more from a career oriented standpoint than from an age or a time horizon standpoint, right? So when you look at it, when you're early on in your career, right, that point of time you need to be more disciplined and you need to achieve consistency. Now mutual funds are the only option that is there for you where you can be consistent as a saver. Your job is to be very consistent and disciplined. So whatever your salary being, some amount and some portion should go as SIP, right? So by the time you have gotten accustomed to the fact of being able to contribute on a monthly basis, by that time on that you are already on a better career path. That is when you are able to take that risk of having a PMS plus a mutual fund, which has to be more of a complement in nature. Right? Like was telling, there are multiple strategies that PMS fund managers do. So we have multiple strategies which are flexi cap and multi-asset and small cap and large cap. Right. Likewise, mutual funds also have a different strategy that they do. Right. So your PMS portfolio and your mutual fund portfolio need to complement each other. Right. So where your PMS would miss out, there your mutual fund should cover. Where your mutual fund would miss out, there your PMS should cover. Right. That can happen only when you have the level of maturity that you built in the early stages of the career when you were being consistent, so that consistency feeds you on for you to take on more and more risk. As you take more risk, as you go on to more you take on better responsibilities, you take on higher responsibilities. So as in your life cycle itself, this is a great time for you to go up and start having a balanced approach when it comes to investing in a PMS and an MF. So it's not either one, right? It has to be both because they need to be complementary in nature. Right. Then comes your pre-retirement. Now, this is somewhere between, your 40 to 45s or your 45s to 50, where the focus before that itself needs to change more from a uh, uh, sorry, there's a question, but okay. Uh, has to change more from, a concentration towards one particular asset class to diversifying your wealth into different asset classes. Right. So asset allocation should start becoming the focus for you, not because you're going towards retirement, but from a more risk management standpoint where you need to be cautious because you don't know what can happen up until your retirement and after your retirement. Like at least while you're in your early career and your mid career, there is a stability of earnings that come to you. But after that, it becomes really difficult to judge the stability of earnings that can come to you. Right. So in the US, there's a very good concept called target dated maturity funds, right? Where as you keep investing in them, as you near your retirement, they have specific dates. So 2030, 2035, 2050, 2055, 2040, something like that. Where as you reach that particular time frame, they rebalance automatically. But what we suggest is not that you should automatically rebalance because you don't know what will happen at that point given the market conditions, right? But the focus should be more on asset allocation where as you near retirement, your assets should and your wealth should get diversified into conservative asset classes, right? Where you have a mix of both so that any problem comes, you're able to save yourself from a for let's say a bear market or a bad market or something where globally there is a bad scenario that's taking place, right? And in your retirement, right, always stick to conservative options, as simple as things can get. If your risk profile is very conservative, then a debt plus strategy would work. If your risk profile, and it all depends on the risk profile. If your risk profile is moderate, at that point, it can be a mix of having conservative equity plus conservative debt. This is where this is why asset allocation is very important for you to have early on, right? Because it helps you understand how each asset class and asset category can work for you, right? So it all has to be tailor made and custom made for you. But during that phase of retirement, I would only say that conservative strategies is something that you should implement. Now whether it is a conservative mutual fund or a conservative PMS, that is something maybe we can discuss one on one. But it has to be conservative in nature. It has to be something where that is able to generate stable returns with lower volatility, right? You can go to the next slide. Right. So the key to investment success, actually, this is 100% investment behavior, but we understand that product selection does come into play because you might be a very good investor when it comes to, or you might be a very good saver when it comes to investing in the market where you built a good amount of discipline and you built a good amount of consistency. But being consistent in the wrong product is not going to help you gather or make high returns in the future. Simple case is small caps in 2018 up until 21. And I've spoken about this multiple times where they do not, that during that entire phase of 5 years, there was a low single digit sort of a CAGR. So yes, product selection works, is very, very important and it works combined with investment behavior. So if you're going to be consistent and disciplined in the wrong product, then definitely it's not going to work for you. So the right product is what is going to help you out, and we are here to help you to make you understand what the right product fit is for you. You can go to the next slide. Okay, so key takeaways, out of this entire interaction with us. So there is diverse roles of PMS and mutual funds. See, PMS play, a significant role during a particular point in your life, during a particular point in your career, because it takes some amount of mentality and some amount of a behavioral trait that is required for you to put your money into a PMS. It's not that anybody or early on should do it. If you're new to if you're new to investing, then please stick to a particular mutual fund. Then there are diverse strategies which become hard for you to understand and what fits for you based on your risk appetite. But if you're just starting off, a mutual fund would work for you, and then it has to be complementary to each other. Then personalized investment choices. It's crucial to align everything to a particular financial goal. If you do not have a particular goal, right, your goal can be as simple as I want to save for my retirement. Now if you want to save for your retirement, then the behavior that has to go towards it has to be completely different, right? So setting a goal matters a lot. If you have a shorter term goal, then product selection becomes even more So that 50-50, then it becomes 60-40, right? So goals matter, and only then we will be able to judge in terms of how your investment behavior is, and second, in terms of what the product should be, right? There's a question on what is the recommended capital. Capital is for PMS is 50 lakhs. For MF, it is no capital requirement. This is as per SEBI's guidelines. Then the importance of professional advice. Now, as we progress forward, going forward, you will have a lot of options available to you. There will be more AIFs coming in, there will be more PMS coming in, there will be PMS houses that get an MF license where more and more and more products are going to come to you. It's very similar to that of what's happening in the US, where there are many ETFs, there are many strategies, there are many leverage products. And then now Vinu was talking about how SEBI is coming up with another segment, which is in the middle of a mutual fund and a PMS. So we are heading into that direction where you're going to have a lot of options available to you. Many new opportunities, many new strategies are going to come up with you. So doing it yourself is going to be much more harder because you don't have the time, right? And for that reason alone, as innovation comes into play, as you see things progress, you have to work with someone to get professional advice. Right? Similar to that of a doctor, many diseases are coming up. You have to go to them if if something comes up and you're not able to figure out what it is. So you are going to go to a specialized doctor. Hence, you need to seek professional advice so that you can get a tailor-made investment plan specific to your financial goals, specific to your particular risk profile. Product does not matter. It can be PMS, it can be mutual fund, it can be debt, whatever it may be. But a profession is only going to be able to guide you in terms of how you can better your wealth creation, something that is tailor-made only for you. Now, how can M2W do that for you? How can Milestones2Wealth do that for you? So Milestones2Wealth, two aspects. One, what is your role? And second, what is our role? Right. So staying invested is your role. We will help you understand what your potential is. We will understand how you can grow your potential. Now, we have multiple checkpoints itself when you start coming on board with us, where we first make you take a financial health checkup, where we understand what your savings potential is and what you're currently saving. Right. Second, we make you take the risk profile, where you become aware of your ability and your willingness to take risks, because these are two separate things. You might have deeper pockets, but your willingness might not be there. I mean, your ability to take risk might not be there, right? Some you might not have a deeper pocket, but you are someone who would like to go all out and whatever you have. So it will help you understand what sort of an investor you are. So these two go hand in hand, where you will be able to understand your potential, and from there on, how you can make sure that that works for you and you're able to grow your potential. What you have to do is this would enable you to save more and to show patience. Right? Patience is one important thing, because if you're a long-term investor, then there will be points where things are extremely volatile. You would have scenarios like what is happening today, like yesterday, how the US job market came, and it does seem that inflation is going to be very high. It does not seem like recessions are being panned out, which means two separate data points are coming in from two separate sources, which is one the Fed and one government, two separate becoming a big problem that does not align with each other. So definitely there's going to be more volatility going forward. It's not just that this year you will have many cycles in which you will face volatility. So as you go from your early career to a mid career, basically making sure that you're consistent to that of making sure that it works for it to work for you, patience is very, very important, right? And staying invested, right? In my stores too, and we don't do trading like what is happening outside. And when you do it with a broker, it is pure buy and hold. It is pure staying invested and showing high conviction in themes and ideas. But that can only happen once we understand how financially fit you are and what your particular risk profile is. Now, is it easy for you to reach that 1 crore? We know you can go to the next slide. Okay, so this is the behavior model that we follow. In a bad market, in a boring market, your participation needs to be much more higher, and in an exciting market, you're of course able to reap the benefits. But from our point, how do we reap that benefit? One is if you're nearing your particular goal, then yes, you will be able to reap the benefit. Before that is only the case. There are only two cases where we say no. These are cases where you need to reap these benefits. Otherwise, it should be staying invested and you showing patience and you doing more. That's it. Right. One case is where we're very close to meeting that particular goal. So hence we need to take out. Second, if valuations run way ahead of what earnings are, which is more fundamental oriented, then definitely it's time to reap benefits. Apart from that, we consider everything to be boring. We consider all market conditions to be a part where you have to continuously contribute and participate in various options. If you're on the program, you would already get multiple messages, multiple communications from our side on what you should be doing as an investor. And as we progress going forward for Milestones to Wealth, it's all going to be tailor-made. Right. So how can you reach that 1 crore? Is it easy for you to reach that 1 crore? Yes, definitely it's easy for you to reach that 1 crore. If you are consistent, if you are disciplined, if you follow staying invested, if you follow being patient. So your first crore, if you're just able to grow at 12%, which is a very base case, right? If somebody is investing in India, you take somewhere between 9 and 12, and we've taken, the higher, which is 12. Within 8 years is what you're able to meet your first crore, but your next crore after that is 4 years, your next crore after that is 2 years, your next crore after that again is a year. So as you go forward, right, you are adding a crore every year by the time you reach the 20th year of your savings and investing journey, right? So it's definitely easy for you to reach that 1 crore, but from your part, you just have to make sure that you're being very consistent and don't spend too much time on product selection. If you work with a professional advisor, even if it's not us, they would help you. They would be able to help you to get the product selection right. And the investment behavior is something that everybody would join hands to work for, right? But when we say that we want to plan for 1 crore, we are actually planning for 10 crores, right? All right. Now I think we'll open the floor for Q&A. Many questions have come. Okay. Uh, Okay, there's a question on please contact personally. I want to invest in US boring stocks through you. We don't do US boring stocks. Boring stocks, again, I'm telling you, is valid proof to show you that being a conservative investor works. Right? It is not up for grabs. We do not have an official portfolio that is uh, given out to the public. It started as a way to prove saying being a conservative investor where you're focusing more on staying invested, showing patience, and getting the product selection right. But in this case, it's stocks, so getting it right works. Understanding broader audience ability to take risk and understanding from a financial fitness point of view how financially fit Indian households are. That was created to show you that yes, conservative investors work. But I think that this has been taken very wrongly by investors because you've seen the name but not looking at how it actually works. There are 3-4 aspects that went into us creating that thing, but it's not up for grabs. What we do is review your 401k if that is something that you're interested in, right? Where we will review your 401k. It is an advisory service where we will be able to give you advice on what you can do on your 401k and how it can sort of work for you. Right? Okay. Does I thought have any EIF? No, we don't have any EIF. Vinod, do you want to take this? What is the recommended capital one should have to consider PMS over MF? Assuming that
Okay.
both of them have 50 lakhs.
Okay, so
Let's assume that.
generally, so Harshal spoke about life stages of an investor. So we'll have to take that into consideration when we're going to be juggling or balancing between PMS and MF. It would be ideal to have both in one's portfolio. Over the longer term, it would be ideal to have both in the portfolio. But it should not be a case where they carve out their entire mutual fund portfolio and just put it in a PMS and then start building MF from scratch. So we would recommend that you build a mutual fund portfolio to a few crores, maybe a crore, crore and a half, And then you can start looking towards a PMS. This could either, at that point in time, you have sufficient base as mutual funds. And on top of that, if you have additional 50, you can put that towards PMS. Or at this point in time, if you have 1.5 crore portfolio, then you can freely just carve out one portion of the portfolio and divert it to a PMS. It may not be a recommendation to have only PMS in your portfolio. That is definitely not a case.
Okay. There's a question on suggest an MF which has investment in US, or does I thought have a PMS which predominantly invest only in the US? Okay. See, we have a PMS that does global investing, but it depends on the opportunity, whether it is a Asian country or whether it is a North American country or whether it is European country. Right? That is one thing. But there is a PMS that does global investing, which includes global investing. It's not 100% global, which is Sphere. It's multi-asset. It would have equity, it would have debt, it would have precious metals, it would have global as well. Right. So if that is something that you're interested in, our team can get in touch with you. Second, suggest an MF which has investment in the US. Uh, I think all the funds are shut. We've met the cap in terms of investments in foreign securities, in foreign funds. So everything is shut now. So there is no option available to you to actually go out and invest. You will not get any units, right? But when it does open, then we'll do a webinar to tell you what you can do. Well, we have done global investments in the past, and it has worked out very well. But now everything is shut, so we are also not able to do anything. Okay, there's a question on, are there any restrictions for PMS similar to mutual fund? Should we invest in a mid cap or large cap option depending on the PMS theme? In the PMS, can we include foreign stocks in the portfolio? For example, some mutual funds include US stocks in their portfolio. So that answer is covered. Yes, we already have a product that we do it on. Vinod, do you just want to take the first part of this? Are there any restrictions for PMS similar to mutual funds?
So there's no, so similar to mutual funds, yes, there are restrictions. The restriction is that if you propose that your fund is going to operate in a certain space, then you have to stick to that. So at the time when a PMS is going to set shop, they will be proposing to SEBI that these are the guidelines under which we are going to operate under. So if it's going to be a flexi cap or a large cap, then they'll have to stick to the guidelines that they've proposed there, the kind of assets that they're going to invest in. But beyond that, it's going to be very similar to a mutual fund. In fact, PMS has a little more flexibility when it comes to having cash in their portfolio. I had mentioned this in one of my earlier points, that they can have any amount of cash if they like to hold cash, but mutual funds do not have that ability to. Let's say a PMS can have even 80% of their portfolio in cash. This is something that around about 6 months back, when markets were a little heated, our PMS funds are only starting with around 20-30% investments. 70% was in cash. But mutual funds do not have that flexibility of having cash. If you invest 10 lakhs, the 10 lakhs gets invested the very next day. There in mutual funds, we'll have to be a little more specific, or we can follow a strategy where we implement an STP or a gradual way of deploying into mutual funds. That's the customization that we can do if you're going to opt for mutual funds. And if you should choose mid cap or large cap in the PMS ecosystem, that should depend on how your current portfolio is looking. The idea is to maintain a PMS plus a mutual fund portfolio which complements each other, where there is minimal overlap, where one portfolio might cover one segment of the market and another portfolio can cover another segment of the market. So it should be a mix and match where they support each other, where they offer sufficient diversification that it does not just, it's not skewed fully towards a particular segment. It should not be a case where you opt for a few small cap funds and then again a small cap PMS. That way you're just in the small cap segment. So when you're going for mutual funds plus PMS, just ensure that there is a good combination that you're going to choose for, and ensure that there's minimal overlap between the two.
Yeah. Just to add a couple of more points to that, see, mutual funds is not bad because see, there's this narrative that and it's a very positive thing to see that many of you voted for better strategy, customization of portfolio, which means that yes, see, if you see what's happening across, right, there is a good amount of maturity that is coming in investors who stayed invested for a long time. that they're able to say, no, I think a more customized approach would work for me, where I think that strategies need to get a lot more smarter and it should not be more, broad based. Yeah, there was a case in the middle where mutual funds were very broad based. Right now, when we review mutual funds and we see what's been happening in the industry, they have gone back to the drawing board to say this is the philosophy of our AMC. We will structure products based on our philosophy now, and they are actually going towards a better strategy. So there is a good amount of competition on both sides, right? So if you see the data that is coming out over the last 1 year, almost 75%, 76% of actively managed mutual funds have outperformed the benchmark, right? Which is healthy because going back, there was again a narrative to say active won't do, passive only should do. And we did a webinar last month where we spoke about active and passive, and how, there was a phase where active missed because of a regulatory change, not because of the quality of fund management. But uh, those things have changed. So there's a very healthy competition with a PMS and a mutual fund. And a mutual fund is much more cheaper than that of a PMS because there's a team that works for you. You're getting it at a broad base, right? If I just have to compare, not I thought PMS versus that of a mutual fund, but in terms of inclusivity, in terms of accessibility and inclusivity, mutual funds definitely offer you that much more better than that of a PMS. That's one. So I would say there are certain restrictions more on a PMS than that of a mutual fund. But what restrictions are there for a mutual fund are not there for the PMS, right? Should we invest in a mid cap or large cap? Look, it depends on your risk profile. It depends on your time horizon. It depends on your risk profile. It does not depend on the returns. If you're someone, when you do take the test, if you're someone who cannot take the ability to see a 25% drop or a 30% drop, that's not the product and that's not the space for you to do itself. Right. NASDAQ also, for example, yesterday there was a lot of volatility on the NASDAQ front, where it just dropped about 2.5%, 3%. Right. So that is a large index, and you see so much volatility there. So if you're not someone who can weather through volatility, don't just stick to a great multi-asset or a flexi cap sort of strategy that is able to give you solid stability, solid returns, good consistency that can work for you so that you can sleep properly in the night. But don't try to chase something. Okay. Okay. What is the recommendation for capital less than 20 lakh? We cannot assist for PMS, but we can make sure that we can plan for a PMS so that this 20 lakhs can be utilized very well. And over the course of time that gets built. But Dinu made a very, very good point that if you're someone who just has a certain amount of capital, then you first stick to building a base itself for the capital. That capital should feed into all the other ideas that you have, whether you have a PMS or whether you have a real estate, whatever you want to do. But I would suggest first take a good amount of time to use this money to create a better capital base, a bigger capital base, I would say. Right. So mutual funds is good. They give you that option. Okay, there is no tax incurred within mutual funds and switching from one stock to another, but a PMS is subject to one. Does the return calculation in PMS account for this tax, or is it calculated based on the net return we receive?
It
This
is
is based
calculated on.
on,
So
yeah, we will take it.
the returns are not, the tax is not accounted in the returns that are presented. Tax, of course, is at the hands of the investor. So yes, when there are transactions in the portfolio, there is going to be tax at the hands of the investor. But here, the idea should be to stick to a PMS which has very low churn in the portfolio, which means they don't make too many changes in the portfolio. So it has to be a PMS. If the PMS is going to be a long only PMS where they're going to be buying and holding for a longer time, then your tax is not going to play a very, very large part, or it's not going to impact the portfolio in a large way. But yes, when you compare, when you're taking a direct comparison with a mutual fund, there is going to be some tax implication. But the point where a PMS makes up for it is in its customization. So customization could be in terms of how we buy. Customization could also come in terms of risk management. Again, going back to one of the points that I mentioned earlier, this may also cover a few other questions in the comment box. the very next question is also on how we, if we can design a different portfolio for each investor. So that's where a PMS is going to make a difference for you. So let's say we're going to start a portfolio in a market like today. So today we may be looking at 30 or 40 companies, which we identify to be good. But not all these 30 or 40 companies may be available at a good place to buy. So some of them may be trading at very high valuation. Some of them may be favorable to buy. Some of them may be very close to what we'd like to buy. But let's say only 10 of these companies are available for us to buy today. And we buy these at some valuation. And as volatility comes, that is going to give us a lot of flexibility to buy more and more of these 30 or 40 companies that we've identified. So the overall goal for what a PMS is going to add to your portfolio is, see, at I thought our core is going to be that when the market falls, we want to fall a little lesser. And when the market starts doing better, we'd like to do a little better. So for this, we try to implement a lot of customization, a lot of risk management into the system. Risk management could be, so the way that we buy is also risk management. The kind of companies that we pick is also risk management. For instance, we try to stick to companies that have very low debt in the portfolio. We try to ensure that the companies that we are picking has superior or extremely good corporate governance. So we want managements that have very, very good experience. We want to ensure that, okay, that there could be a good management, but we want to ensure that this management actually walks the talk. They execute what they say. For this, we go back to 10 years of data to see if every time that they've told something, have they executed? What has been the trend of their execution? So these are things that come into the risk management part of it. This is something that we try to implement very, very closely in the PMS when we build each portfolio. So when each investor comes in, it's going to be a unique portfolio that's going to be built for them based on when they enter the PMS. Let's say one investor enters today and one investor enters 6 months later. The portfolio is going to be slightly different because the opportunities that are available today is different from what might be available 6 months later. Or if you even take a portfolio that is being built today versus portfolios that we were building 2 years earlier, where 2 years earlier we had more towards mid and small, and now we're slowly shifting towards areas which are a little more large cap oriented because that's where we find value. So this kind of change is something that might be implemented in each portfolio as an investor begins. So yes, the PMS is going to offer a unique portfolio for each investor that starts.
Okay. There's another question on if I have 20 lakhs, how can you guide? I'm already doing SIP with you. Just continue doing your SIP. What I would suggest is you step up your SIP. Uh, if you're able to, I would say review your finances first. When you review your finances, you would get a savings ratio. And if your savings ratio is somewhere between 50%, then your target needs to be that you need to go up to 65%, 70%. So as your income grows and you're able to maintain that 65% of savings ratio, that extra is what should come as a step up so that you can meet that 1 crore even without doing a PM. Right. But if you want more understanding of, uh, your savings ratio, just send us a hi on the number, get in touch with your point of contact and tell them that this is something that you want to work on straight away, and we'll build a plan for you.
So I think we have a lot of questions. We'll just go through one by one quickly.
Okay, that's a good question. Can a person part of Milestones will be absorbed into iThought PMS once they reach 50 lakhs? Will a PMS allow me to hold MFs as a part of my portfolio to avoid taxes? Avoid taxes? I don't know if avoid taxing is. I don't think you're going to avoid taxes. But as an organization, are you looking at MTW a way to onboard early investors, helping them smoothly onboard into PMS without much redundancy in the investor's portfolio? Currently, roughly how many people are onboarded on the successful program like Milestones2Wealth? Very good question, yeah. Seems more operational than usually what we get. Right. Yeah, we don't force people to say that no, if you're coming here, you need to do this. No, if there's enough aspiration, then we plan for it. But there's no condition saying if you come here, you have to do this. Number one. Second, PMS will allow you. PMS does not allow you anything. It's a discretionary PMS. the power of attorney lies with the fund manager and not with you. But if you're having a PMS, and if you think that having a PMS and having a mutual fund is going to be a problem, no, it's not going to be a problem because we manage it more complementary in nature. So there won't be a problem when you're holding it. I don't think that avoiding taxes is something that is going to, you cannot avoid taxes. As an organization, are you looking at a way to onboard early investors, helping them smoothly into PMS after that? No. Milestones to Wealth was started to serve a bigger purpose because there are new investors who are coming in into our system. You would have seen, and I'm sure that you're very well aware of the big demat numbers that are coming in. So the point is we want to make sure that every investor that we work with comes with that idea that they need to save and build a crore worth of corpus. But that crore worth of corpus, we understand, is more from a 10 crore idea, where the whole idea is to make them disciplined, is to make them consistent with their savings, make sure that they increase their savings ratio, right? Simply put, savings ratio, so that they are able to meet their goals. Because India today is at a inflection point. If we are able to grow 6.5%, 7%, and if we just continue what we are doing, yeah, there's a slight slowdown last 2 quarters, but from a broader overall sense, right? If we continue what we are doing, then even somebody who's able to do a 10,000 rupee SIP will still be able to get to 5, 6 crores before they retire, right? So our endeavor is to make sure that financial wealth as part of your household savings is higher and it works for you. Our goal is not to beat somebody else in returns and give you the best form of returns. No, our job is to make sure that you're consistent as a saver, you're disciplined as a saver, and you're continuously saving into the right uh, products, the right asset category. So that is where we come in. We come in only to manage risk. We come in only to make sure to provide you something, options and strategies that offer you stability and consistency with lower volatility. It is not that you're not going to have volatility, you will have lower volatility, is what that's what our entire aim is. So no, it's not a way for us to siphon off from one and go to there so that we show the numbers here. No, there's nothing happens there. But we do have investors on Milestones to Wealth who tell us that no, I want to plan just to, I cannot save for 50 lakhs. I'm not attuned or I'm not accustomed to being disciplined and consistent as a saver. So help me save up to 50 and then I'll take a decision on whether I want to go to the PMS or whether I just want to do this. We tell them, why do you want a break in terms of your wealth creation journey? If you still insist that no, you want to do this, then the product that goes itself to them is not something that is extremely aggressive that they cannot digest, right? So it all gets planned for if that is an option. But we work with about 1,400 investors on Milestones 12. That very small segment that says I want to do it, but aspiration is very high. Okay, I have already a SIP running. Will my PMS consider to reduce the redundancy? I don't know what redundancy means, but you want to take this?
Sir, not sure what the question exactly means, but if you're asking if you run an SIP in mutual funds, would the PMS have any sort of overlap? If that's what you're asking, with all our PMS funds, we try to ensure that they are completely unique from what the industry already offers. Because if we're also going to be doing what a mutual fund is going to be doing, then we're not doing anything different. We're not adding anything to the investor's pie. So if you're going to be running an SIP in mutual funds, the PMS definitely is going to be a complement to that. It may not have a similar portfolio. I have two aims. One is children's education and other is retirement. Can you suggest one mutual fund which can cover both? I'm expecting your reply. So this, you can get in touch with our team who would be able to give you suggestions on how both of these goals can be planned in the mutual funds. In mutual funds, we may not be able to give you any mutual fund suggestions here. Is there any lock-in for the PMS? There is no lock-in for the PMS, sir. but some PMSs do have an exit load. It varies from each fund, from fund to fund. You may check the terms of each PMS fund to see if the PMS that you are looking for has an exit load or not. But PMS, portfolio management service funds, in usual do not have any lock-in period. Are
Okay,
there enough
interesting question.
opportunities to start a PMS? Go ahead.
Look, you don't try to time it because a fund manager is already going to time entry into a particular stock, whether it is a mutual fund manager or PMS manager. What you have to decide is no, I'm going to invest now, and over the course of time there will come many opportunities for me where I have to step up my SIP, or there are cases where I can do a big lump sum because of a bonus that I get, or some property sale that I want to transfer into equity. So you will get many options over the course of your journey itself where you can participate higher. But if you want to say, are there enough opportunities to start a PMS? No, no. There are enough opportunities, be it with us or be it with somebody else. It depends on the strategy. There are many strategies. It's a great time to go and invest in that particular strategy. So there's nothing to say that no, the timing on your part, the decision on timing on your part needs to be lower because the fund manager is anyway going to try to time things. Okay. If somebody joined a PMS during the peak of a market cycle, the second one joins after 15% correction after 3 months. In this scenario, at the end of 1 year, how does their portfolio look? I don't know how their portfolio will look. What is the benchmark against a PMS fund? PMS, there are four categories. Equity, then there's multi-asset. So we are supposed to benchmark it to Nifty 500. For a multi-asset, we are doing multi-asset index. There are many options through which we can benchmark it. But APMI does this. I think there were also questions. We'll take that one also. Where do I see returns? You can just go to APMI. APMI has the benchmark that a PMS can choose from, a PMS strategy can choose from, and what the returns are. Historical returns also will come there. But I don't know what their difference in return would look like because we don't look at headline numbers. We only work with the person to make sure that they are able to participate at all times. So what if that person is able to participate higher than you are, then your returns will be lower. What if you are able to participate even more than that particular person? I don't know what the particular scenario is, but
So one
everything
year is
is
again a very short time to be looking at it. So the idea should be to look at a 3 or 5 year period where there is going to be ups and downs over the course of the journey. But the idea is that if you keep adding capital throughout this journey, your returns are going to be more or less diverged. Most investors' returns will be diverged. That's what we've seen.
yeah.
Is it
Uh,
current
is
time
it
to
the right
invest in a
time?
PMS? So the idea behind a PMS itself, we've been using this word of customization a lot in this webinar. The idea behind a PMS itself is that you should be able to come into a PMS at any point in time, and we're still going to be in a position to build a portfolio for you. So there's no guarantee that the portfolio will be built tomorrow itself. Full 50 lakhs or 1 crore may not be deployed tomorrow itself. But the idea is any point in the market, whether it's the absolute peak or the absolute bottom, if you come in, we are going to be in a place where we can build a portfolio that is appropriate for that time. Because I can't build the same portfolio that I built for somebody. See, 5 years earlier, somebody started has made 30% returns. But I can't pick the same stocks that I picked for that person and build a portfolio for you because that is irrelevant for you. What returns I made in the past 5 years is also irrelevant for you. I may have made 30% for that person. But from today's market, what can I make for you is what I'll have to see. So based on where we stand today, we'll be building a fresh portfolio for you.
Correct. There's a question on which PMS from iThought is focusing on US market. I'll change the question. Does iThought focus on investing in global markets? Yes. Do you do it via the PMS? No, we do it with via the PMS and the mutual fund. So we do both ways. So if you're on the mutual fund side, you will still get opportunities. If you're on the PMS side, there is one particular PMS called Sphere that does have the option to invest on the global markets. The global percentage in that particular fund is somewhere in that particular strategy, sorry, is somewhere around 5 to 5.5%. right? So yeah, we do global research. Because when we want to invest, then we need to have some idea, good idea, to make sure that we are not doing the wrong thing. But yes, I thought focuses on global markets, not alone US, global markets, and both the mutual fund and the PMS have options to do it. Are all PMS publicly available? Yeah, they are. What's the CAGR that I'm expecting a PMS for a period of 10 to 15 years? Just expect somewhere between 12 and 15. 15 to 18 is very, very good. But somewhere around that range is something that you can expect from, I thought, be it a PMS, mutual fund definitely will somewhere be between your expectation. General expectation should be 9 to 12. 12 to 15 should be, see, these are all base cases, okay, over a long period of time. So I have those expectations alone. We've taken the return expectation. As a retiree, is it still better to have to PMS or change to debt and continue with HWP if my risk is good? I think you should continue what you're currently doing.
Now, this
Uh,
depends on the capital that you have. This
yeah.
depends on the income that you require. If you have, if your requirement of income is going to be much lesser or very small portion of your overall capital, then it's okay to have a PMS. Maybe that portion is going to help you beat inflation over the longer term. Your retirement fund should also be able to beat inflation. So it's good to have a mix of debt and equity in your portfolio, but whether that equity segment should be in a PMS or mutual fund depends on the size of your portfolio. So you can get in touch with us. We can review to see what would be a better option in your case. So it has to be a case to case basis. So we'll see what might suit your case better.
Okay, with MW, is there a goal financial planning that happens with the investor before MFs are suggested? Uh, See, the conversations are in depth, where there are, like I said, right, there are checkpoints. Risk profile comes in. Uh, Financial health checkup includes all of this, where we plan for, what your potential is and what your, goals are and how we can match it. And it happens only based on that. It's not uh, I would say it's a roadmap to a financial plan, but it's not a financial, it's a roadmap. It gives us some direction on the health checkup does give us a good amount of direction, and the risk profiling gives a good amount of direction on how to plan for a particular goal.
MF has auditing, sometimes we heard. So yes, PMS also has auditing. To answer the very next question, yes, SEBI, PMS comes under SEBI's eye. This is something that SEBI closely monitors every product that is out in the market, be it mutual funds, be it PMS, AIF, or the new SIF that's out there. There are very strict guidelines of how a PMS has to be run, how an account has to be set up, how a DMAT has to be maintained. So there is some high level of monitoring that goes on in a PMS, because this is particularly meant for higher capital investment. So SEBI has a separate wing that looks at this. And yes, we have to submit audits of what's going on in our portfolios, transactions, all of those to SEBI on a quarterly basis at least.
See, every decision we make is accounted for. Be it, let's say, in a day for 100 people, then it all gets audited. It's even more stricter for that of a mutual fund, because we came from a period in 2018 where these type of regulations were very low and many scams used to happen. It's not that a scam can't happen, but our internal processes are above, that of what the industry does in terms of, and everybody has to do this, right? So for me to claim saying it's above itself is not okay, but everybody has to be compliant with SEBI, and everybody maintains very strong compliance structures, very strong, whether it is on the MF side or whether it is on the SEBI side. They have to. We can't play around with the trust in society, and we can't play around with your trust. Okay.
Approximate fees for PMS, it would vary from PMS fund to fund, sir, depending on which fund you are looking for. Again, we'll have to check the terms of the PMS fund to see what the fee is. The next question is on if you're keeping cash in the portfolio for a longer time, in this case, annual return on the investment will be lesser. So are we protecting capital? So see, the entire reason that we may be holding cash in a portfolio is because making that investment today could be risky. So it is, so we should not be looking at a period of 6 months or 1 year or even 2 years, I would say. Any sort of equity investment, be it PMS, be it your direct stocks, be it your equity mutual funds, always look at it from a 5 year point of view. Over this 5 years, if a portfolio can do well, then that's going to be your outcome. So why I'm saying this is because if you take the last 1 year, there are cases where one of our PMS portfolios was underperforming because the markets were doing well, but we held cash in the portfolio. But as markets became volatile, or if you take today, we've managed to fall lesser and we managed to pick up some high quality companies at a very, very cheap price. Now, if you take today, the same portfolios that were underperforming a few months back have started outperforming today. And when the market starts going up from here, the outperformance is going to be even more. Because one, like I mentioned earlier, we've fallen lesser to the benchmark and we've managed to buy more at these prices. So when the market goes up, naturally, these cheaper companies are going to fire. So for maybe periods of 6 months or 1 year or 2 year, there may be some sort of divergence in or underperformance or outperformance between benchmarks and the PMS, but you should be looking at it from a 5 year or a 6 year point of view for any sort of PMS or equity investment.
Okay, there's a question on, does every individual within a PMS have a different portfolio? If yes, how does the overall return percentage? See, it's different in terms of your participation, right? So, for example, portfolios that were very old and somebody who doesn't have the ability to participate, their portfolio is run in a particular manner. So changes happen at a particular time for them. Additions happen at a particular time for them. So from that logic, it is completely different, right? But let's say somebody came, in this period of 1 month to 2 months, their portfolio at the start would look very similar, but going forward after that, as participation level changes, portfolios would look different. Uh, does the overall return percentage for so how does the overall return percentage for PMS calculated? No, it's a
It's an
again, it's from
average
a
of
fund.
the overall
Yeah, it's
funds.
a fund based, so we will get that. So all investors would something be around that particular range only. And does it vary with individuals? Yes, so it's like a mutual fund. So depending on whenever you come, it would be different.
So different may not mean a completely different portfolio. It may mean that each portfolio may have some securities that will be different because maybe when you came in, those securities were not at a price that were good enough to buy.
Correct.
So in that case, you may not have certain stocks that an investor who was in the portfolio 1 year earlier had. So it may not be a completely different portfolio, but it will be a portfolio that is going to be relevant for you today. That's how it is
And
going to be.
understand that we are not selling you the return. We are selling you the strategy, right? Which from an overall perspective ultimately will reflect onto returns. But what we are ultimately selling you, better strategies, what we are looking to sell, not the returns. You see, the thing is that when you look at the number at the bottom, you get very excited when you see a high return to say that this is what that's a great return. We are going to do this for a long time. But it's the strategy that matters where we're able to give you that level of low volatility and sustainable wealth creation sort of returns. Like that's what we are looking to do. Our strategy is what we focus on majorly and not the bottom line. Bottom line gives us an idea on, okay, are things going according to plan or not going according to plan? That's it. Okay, when SIF will be started, will it be similar to PMS and what are the charges? Don't know. Let things come out. I don't think anything has come out after that. Let's wait for it. Not a priority. Okay, I understand about long term, but Mr. Sham always compares year over year with index and he wants us to sell too. Isn't that contradictory? See, when we say long term, right, we say that there should be a proper direction in terms of one, why you are investing, and for how long do you plan to have the same goals. That's why we think from a more goal oriented perspective. So wealth creation in retirement becomes easy to plan for because anyway it's long term. So yes, But something like a education comes, something like a house goal comes, then definitely we have to see from a how long is that. If it's 5 years from now, then the plan for that needs to be completely different than that of a 20-year horizon, right? We compare year over year because the demand coming in from you is you compare year on year and show me what you're doing, right? But when we compare ourselves 5 years, 6 years from a long term, when we want to say that no, we would like to compare only from a 5 year to 7 year perspective, then there's a healthy outperformance that comes, for us. But this Y and month on month, 3 months, 6 months, all of this is this is industry. The entire industry shares that level of data because there are different sets of investors who ask that.
Well,
The
if this is about the boring portfolio review, then this is just a series that we have. Again, this is only for educational purposes. We do not intend to compare anything year on year. Since it is for education and since it is a series of videos, I'm not sure if that is what you're referring to, but since it's a series of videos and it's going to be posted once every month, we put it out for comparison. And he wants us to sell. So again, this is not given as advice. This is again something that he may do in the portfolio. See, this goes back to one of the earlier points that I mentioned where long-term investments, yes, long-term investment means staying invested for the long term, but not necessarily in the same set of companies or same set of mutual funds. If something is going to become a little more overvalued, if something is looking a little more risky, then wouldn't it make sense to walk out of that than to stay invested? Because if I know that this is going to be a risk in my portfolio, even if it's just 1 year old, even if it's just 3 months old, if something has become overvalued or something has become risky, it would make sense for us to move out of the portfolio. So yes, it is going to be a long-term journey, but there may be instances where these are going to be rare instances, but there could be instances where within a year or even 2 years down the line, there could be some change in the way that the company is operating or change in the view of the company. So in that case, we will have to take some action. And
See in
if
our
you take
history,
particularly, go ahead.
no, see in our history, we've had barely 2 times since 2019 where we've had this level of issue where no, we have to change things. Otherwise, we are still having names that we are holding since 2019. Right? And 18, 19, 20, there was deep underperformance in a particular big segment of our portfolio. But we held on to it. We made sure that participation is happening continuously in it, so that we are able to do it at so because the margin of safety is there, so we are able to do much more. We are able to gather much more units, much more shares of that particular industry, particular sector. And ultimately, when things start to do better, when the cycle turns, you reap the benefit out of it. But from a when we take a decision itself, we go in with the view that no, we understand that certain changes need to take. Otherwise, you shouldn't be taking risk at all. Then FD is the best for you, right? Risk means that yes, you are willing to go through the life cycle of one you and second the life cycle, right? Travel with the company, right? Travel with the company's growth prospects, what's happening inside, and that ultimately, when you show the patience, it ultimately reaps to some good amount of benefit, right? Okay, can we add fund periodically in our PMS? Yeah, you can. You can do SIP also, no problem. You can do. Okay. First lesson in stock market is do not try to time the market. If you're waiting for a stock to come down to your preferred level for a long time, are you not trying to time the market? For all you know, that stock may never come down to your preferred. Are you asking us or are you telling from a general audience that this is what happens?
I think it's a question. Do you want to take it or should I take it?
I'll take it. Okay. Uh, and it's in caps. Are you trying to time? Are you not trying to time the market? Okay. See, in terms of timing, right? When you go to the doctor and the doctor sees, okay, today, you are having this particular symptom. So you go and take Dolo. Now, let's say you don't go itself, but you just keep popping Dolo, thinking, okay, it all gets sorted. I'll still be able to do much more better. No, it's not like that, right? When we say timing the market, we don't mean that there has to be layer over layer over layer to say that, what is the decision to take. First, timing the market itself from our view is more from a a margin of safety perspective. It's not that today, if I buy the stock 10 years from now, it will be 10x and I'll make ultimately this return and project some fancy number to do or to satisfy your needs. No. When we say timing the market, we only look at it from a margin of safety perspective to say that, okay, the time that we choose to enter or the time that we choose to invest, are we doing it at a period where a lot of negatives have already been factored? One, all the bad has been digested by the business, digested by the sector, digested by the entire industry, right? Third, okay, at this particular price point, given whatever has happened at this particular price point, what is the expected earnings that is going to come out in the next few years? If it matches, then yes, we have timed it well. If it has not, then definitely. So when we start, it looks like, okay, the timing is right. But going forward, we see that from a reality perspective, that no, many things are not happening the way it's supposed to. Hence, that point of being able to participate at opportunistic times comes in. Right? We take care of making sure that when we try to enter, it's at a time where a lot of margin of safety is there. The probability of losing capital is low. Probability of losing capital is low, right? We only look at it from that aspect, but we do not look at it from that aspect of this chart says 150. 150 shows it can go here to 200, and then we try to time that. We say don't try to time that.
Just to add to that, sir, when we're saying we have to be on cash and be vigilant with when we invest, it does not necessarily mean timing the entire market. It means timing a particular set of companies that we are interested in. Yes, like you mentioned, some of these companies may never come to the price that we prefer. But if that does not happen, then we're happy to not enter the stock itself. Like Harshal mentioned, the price that we'd like to buy it at has a certain level of margin of safety. It does not mean if you're going, say, we may, in our PMS ecosystem, we are tracking more than 100 companies. And a lot of these companies we'd like to buy, but some of these don't come to the price that we'd like. So there are companies we've been tracking for more than 4 years, which have not come
Still
to
we
our
have
price
not
range.
gotten that price. You're right, Vinu. Still we have not gotten that that price point. Yeah? We've been seeing this for the last 4 5 years. Never, it's not coming only.
So we're looking at other opportunities to participate. It's a broad market, sir. It's not a question of just these stocks. There are so many other stocks that we can buy and hold in the portfolio. Then there's this one analogy that I keep sharing from time to time. So let's say there's a phone that you like and it's valued at 50,000. Would you, knowing that this phone is at 50,000, would you go and pay 60 or 70,000 for it? Or would you wait for it to come to 50 or 45? Or I may just start looking at another phone that's as good as this, which is available at a good price. So we're trying to do the same with stocks. We're trying to, it's not timing the market. We're trying to identify a very good time, or we're trying to identify a good price or a good value for a company that is good. So it may not be timing the market, it may be waiting for a better valuation. You can
Yeah,
put it
little
that way.
discount, little sale, something. We are Indian investors, we want a discount at everything. So let's, why not ask and wait for a good discount to come?
Okay, that seems to be the last question. This was a long Q&A. We had a lot of good questions.
Okay, how much exposure to a single stock? Depends on the PMS, depends on what their methodology is. We don't go beyond 5% in a particular business, that is in a particular strategy. Other strategies we are able to cross 10% also. Depends on the strategy. Very interesting and informative webinar. Thank you. Thank you so much. Thank you so much for joining in and spending time with us on a Saturday morning. I'm very happy to see so many people stayed up until the end of the presentation, up until the end of the Q&A. We had a long 1.5 hour session today. So I really appreciate your thank you so much all for joining in. If there are some questions that we have not been able to address, if you still have further questions, when you just put out the number, no, just send us a hi and regarding your question, and we'll do our best to address it. Thank you so much for your time. Happy Pongal to all of you. Happy Makaran Sankranti to all of you also. Thank you.